Welcome to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next week. Okay. Hi guys, welcome back to Macro Insight. It's the 3rd of November, and let's have a look at the markets. So last week, what do we have? Obviously, pretty rough week last week, as COVID restrictions kind of got ramped up across Europe. And now the UK has also announced a nationwide lockdown for a month, starting on Thursday this week. So not good on the COVID front. So that obviously took markets down in a risk-off move. DAX definitely took the brunt of it. So we can see, DAX had been kind of getting back to towards this 1200 level, and then took it out in style, went all the way down to lows of around 11.5, but has managed to stage a bit of a bounce off there. So if we go to the 1-day chart on the DAX, you see pretty decent move lower, obviously down to the lower Bollingers, taking them out quite dramatically, but finally managed to stage a bit of a bounce over the weekend. Oil also took a pretty big hit, but same story with oil. Obviously, with all the restrictions on travel, etc., you'd expect oil to get hit. It did. It came in from $40 all the way down to the low 30s, but now staged again a pretty impressive bounce. The US S&P, same story, not down quite as much as Europe, but pretty bad week last week. You can see from 34.60 kind of down to 32.30 lows. Managed to hold on to that. We've got a big level around the kind of 3200, 3190 area. Managed to stay above that, which is encouraging. Also bouncing off the kind of lower Bollinger Bands. Again, encouraging. All eyes are going to be on the US election, though, obviously, right? So, well, why have we bounced? Well, I think there's a bit of optimism, hopefully, that once we get the uncertainty of the election out the way, then we should get some sort of relief rally. That's the general kind of feeling. But yeah, all eyes are going to be on the election tonight. Yeah. So, what are the scenarios for the election? So Biden's obviously leading the polls. And as he has done for a long time. But we know that things are closer in the battleground states than kind of the popular vote, right? So it's highly, highly unlikely that Trump will win the popular vote, but it's the battleground states that matter. And same story, that's what happened against Hillary back in 2016. So battleground states are states such as Florida, Arizona, Michigan, Pennsylvania, things like that, where the polls are generally a lot closer. Also, a lot of Trump voters actually don't like to admit that they're going to vote for Trump, so that the polls tend to be a little bit underestimating the Trump vote, it seems, in general. But hopefully, a lot of the pollsters have kind of adjusted for that, and so they'll be a bit more accurate than it was back in 2016. Okay, if you look at the betting odds, which are also quite a good indication of what the market thinks. The betting odds have been in favor of Biden, obviously still are, but they've had a bit of a move in the last couple of days towards Trump. So, but that's quite typical of as you get closer to the event, often the odds even up. And I think a few big bets have been put down on Trump lately in the betting odds, which have kind of moved it back towards him. But it still is very much fancying Biden to win. He's definitely still the favorite, but like I say, just creep back in Trump's direction a little bit. Okay, so the real question on the election is going to be, will we get the blue wave, right? So if Biden does get in, is he going to take the Senate as well? That seems to be the outcome that will probably trigger a decent rally in markets, at least initially. As they will price in, a strong stimulus likely in January, but in the order of getting close to 3 trillion, which was going to support the economy, which clearly is facing a potential escalation in COVID situation, like what's happened in Europe, right? So there is a fear that the lockdowns that are sweeping across Europe are now likely to be coming through in the US over the coming month and into the winter. So a strong blue wave win will hopefully, you know, have the stimulus supporting that outcome. So that's one thing. The problem with that, there will be a fear though that with Biden in, statewide lockdowns might be sort of a bit more likely. So the kind of restrictions will be worse than what Trump wants to put in, for example. So that might have more economic impact as well. And then you've also got the fear of tax hikes coming, because they've been talking, you know, about tax hikes and regulation and things like that, which are not as market-friendly outcomes. So you might get a knee-jerk rally on a bit of sort of a relief rally, but then likelihood is that the sting will be taken out of that rally because people will focus on the not so market-friendly aspects of a blue wave. The thing you are probably most likely to get is a bit of rotation out of some of the winners, like the tech stocks, and into some of the losers, like your beaten up travel and leisure names and your banks and things like that, right? So I think that's the thing you could probably be a bit more confident in a blue wave win, is the rotation, than just the entire market going up by a significant amount in the short term. Yeah. So probably the outcome that markets are going to like the least is going to be the contested election, obviously, that then drags on for weeks. That's probably more likely to happen if Trump takes it on the night, but there's a bunch of mail-in votes that the Democrats need to count up, and they might, you know, they'll contest it, and it goes on basically. Market won't love that outcome because the uncertainty will remain, and the worst part will be if you then trigger some sort of civil unrest across the states, where you've got lockdowns coming as well, you've got no fiscal support package being agreed because you don't even know who the president is, and those sort of things could start to snowball and get worse. And the market definitely won't like that, right? That'll be the most negative market outcome. Yeah, that's not my base case. My base case is that we probably know a winner by the end of this week. Maybe not on the night, but by the end of this week we should. And in that case, we'll get some kind of relief rally as that uncertainty goes away and that risk of contested election goes away. And then the thing I'm probably most confident about is vol going down. Right, I mentioned it last week. I think vol is escalated, and I think the clearest trade right now is the one where you think about selling vol. Right, so we can have a think about that. I mean, the VIX itself, the VIX spot, you can see here, last week got as high as 40. It's still pretty elevated up here at 35. S&P itself has been realizing 20 odd, so we're still easily 10 vols higher above that in terms of VIX level. And you know, you can just see here we've got a lot of room. We've got a lot of room to get, you know, even back to 30 is 5 vol points, but we could easily go back to sort of mid 20s, I would say, heading into the end of the year. Even if we get a bit of choppiness around the election, I think a 25 VIX level is still an elevated level. Still reflects the fact that we're not in a great economic backdrop and we're likely to see some volatility. But I just feel here there's just too much premium priced into the election. And if you look at the election outcomes, whichever knee-jerk reaction we get, whether it's a contested election that then ultimately gets resolved, we get a dip and then it gets brought back over the coming month, or we get a conclusive win, we get a knee-jerk move higher, but then we have got lots of headwinds and potential things for the market to not get ahead of itself, right? So I think any move in equities, whatever the knee-jerk is on the election, will most likely get faded. It will either get faded within a day or two, or it'll get faded within a few weeks or a month. But I think it'll get faded, and that's ultimately why I think selling vol is the opportunity here. Okay. So that's my view on equities. Then if we look at FX, we can see the DXY had a little move up towards the top Bollinger Band here, around 94 and a bit. it's now coming back off as people, there's a lot of sort of election crib sheets going around for like the different outcomes and the scenarios, and pretty much all roads lead to the dollar coming off, it seems. Yeah, or most roads do. So that's why, you know, we've started to now see the dollar come off, and we may well get an acceleration in the dollar back down towards the lower end of that range. And if we get a blue wave, then who knows, the dollar could very well take out those lows. And we see the move we've been talking about in the dollar, and generally that move in the dollar will be good for risk assets, right? So in a blue wave where the dollar gets crushed through the lower support levels, that will take risk assets up with it, I imagine. Okay, so that's kind of FX. If we look at cable, obviously Euro's pretty much the mirror image of that. Nothing really to say there. If we look at cable, it's been a little bit different. It's been holding. Despite the lockdown news in the UK, which normally would have taken cable down, it held around that 128.5 level. Yesterday's price action showed that cable cares more about Brexit than it does about the lockdown. And there seems to be some optimism that Brexit deal will get done, in terms of the only thing they're arguing about right now is fishing. And the market, it seems to me like the market thinks they're going to reach some sort of compromise on that. Okay, so whether that happens or not remains to be seen over the coming weeks, but that's kind of what the market's shooting for, and that's keeping cable from collapsing right now. Yeah. On the gold front, gold and silver, it's going to be pretty much what the dollar does. It's going to be driven by that. We bring up the gold chart here. Yeah, it's having a decent bounce in. Like, it's been pretty correlated for risk assets last week. Gold was getting hit, got down to lows of kind of 1860, 1870 when the market was getting sold, when the equity market was getting sold. It's now had a decent bounce off there, along with that dollar weakness and the kind of idea that Biden's in front, and if Biden gets in, that's going to bring stimulus, which is going to probably lead to gold and silver rallying with risk assets, right? So that's everything's quite correlated right now. That seems to be where we're going with that. General commodities, same story, right? Commodities pretty much going to do the opposite of what the dollar does. Yeah. So nothing really to add on there. I mean, we did break out of that triangle that I had mentioned on gold that we were carving out. We broke to the downside. We didn't get quite as far as I would have liked. I was hoping to get towards this sort of level of 1830. We didn't quite manage it. This may well be it in terms of gold. If we do get a blue wave, if we do get general stimulus coming through, then gold back to the races over the next few months, probably. I'm not sure we've had the ultimate sort of break or resolution of that triangle yet. It will remain to be seen, but I'm open-minded right now. You know, in that bad outcome for the market, where we kind of get some uncertainty dragging on with the election, yeah, could gold go back down to this level, 1830, with equity market selling off? For sure it could. But we could have already seen the lows in gold, and we could be rallying again. I think it's going to be determined by what the dollar does and what risk assets do post-election, right? So, well, I watch this space, basically. So really the big thing is now the opportunity for the election is to sell vol, right? So how do you sell vol? There's multiple ways to sell vol. Now, I would say there's dangerous ways and there's safe ways, right? There's aggressive ways and there's safe ways. So I put a Twitter thread out about this morning, about how do you take advantage of this vol selling opportunity. So I said, you know, if you want to sell vol safely, which is, as a retail person, you know, I would kind of recommend you do it in a more defensive manner so you can't lose too much money, but you can still sell vol. So one way would be to use what we call iron condors. So I'm going to show you on my interactive broker screen how you can go about constructing an iron condor and what that looks like, basically. Okay. All right, here we go. So here's the option chain for the S&P, okay? And you've got this thing called a strategy builder. And so what an iron condor is a combination of strategies, options that consists of selling a call spread and selling a put spread, okay? So if we go to, say, December expiry, so what I would recommend is selling, you can sell November, it's a bit more aggressive, it's got a little bit more risk on it because it's so short term. But December probably gives you a lot of time for this market to kind of chop around and find its equilibrium and this premium to just erode away to zero, right? So you can say, what range do I expect the market or the S&P to sit in between now and December expiry, which is middle of December, so 45 days, okay? So if you don't think we're going to breach the highs, which are around 3,600, on the upside, you could sell something like the 3,600, 3,650 call spread, something like that, okay? So you can see the 3,600 calls are worth around 24 index points, 25 index points. You can sell those. And then you could buy the 3,650s. Okay. So the most you can lose in selling that call spread is the distance between the strikes, which is 50. Okay. So now let's see what put spread we can sell. So the market has been struggling to kind of breach 32, but let's give ourselves a bit more room on the downside. So, you can have a look at a chart on the S&P to decide where you think the supports are. But, I kind of think 31 is a decent level. So let's say you sell the 3,100 puts and then you buy back. Now, it depends how aggressive you want to be. But I would recommend kind of buying back the 3,000 strike. So the put spread that you sell is 100 points wide. And the call spread that you sell is 50 points wide, okay? So then if you look at the combined price of that strategy, it's basically worth around 26 to 28 points. And mid-market, let's call it 27 points, okay? So you can sell that structure, and what you're looking for is that you've got this payoff here. I don't know if you can see this very well. But basically, you earn money if we stay within the range. If we break out of the range, then you go into negative territory. But the amount of money you can lose is fixed, okay? And also, even though you can lose a max of 100 or you can lose a max of 50 on the upside and you've collected 27 points for that, so really it's 100 minus 27 that you can lose on the downside, and it's 50 minus 27 that you can lose on the upside. So the risk rewards aren't horrendous for selling vol, which is what you're doing, okay? The truth is you can cut this position early if you want to. So you don't have to sit there and wait until middle of December if the market breaches either end of the range and you're going to lose the money. You don't have to sit there and wait to actually lose the full amount of money. The truth is you'll be able to cut this position for maybe 50, 60 points, whatever it is, at least sort of 2 weeks before the end of it, which is middle of December. So by early December, if it doesn't look like we're going to stay in the range, then this structure will be worth something like 60 or 70 maybe, and you'll be able to cut it. So you'll be able to cut it, and it'll be a loss of around 30 points from where you collected, right? So you're still only losing what you were due to make. So it's about a 1-to-1 risk reward of what you can lose versus what you can make if you cut it at around 60, yeah? And if we stay in the range, then you're just going to be sitting there in the range, and this thing's going to evaporate in price to close to zero, with a couple of weeks to go. And then if you choose to buy it back for 2 or 5 ticks or whatever it's worth, then you can do that too. So that's the nature of this. The nature of this structure is it will earn theta. It will make money in a vol selling environment where things stabilize and vol goes down, but it won't blow you up. Right, the risk with a lot of short vol strategies is that they can become quite negatively convex and lose you a lot of money and the risk reward is really bad, right? So you can make X and you can lose 5 or 10X if the market moves dramatically. This type of structure allows you to contain that scenario and kind of stop yourself from that mistake, basically, right? So that's the idea, okay? Another way to sell vols safely is to look at the VIX. So, we've looked at Vix Central, which is kind of a site that I've been showing you for the term structure. So Vix, let me share my screen. So here's the Vix term structure. Okay, so you can see that the December contract's at 32 and the January contract's at like 30. So that's 2 vols above. Now that's called a backwardation. Normally this curve doesn't trade in backwardation, it trades in contango, and you have an upward sloping curve, and that's in normal markets that aren't stressed markets. So if we're likely to go back to a normal market, if we're going to get a normalization post-election in this curve, right, then what you should expect to see is the December contract to drop towards the kind of mid to low 20s probably. We're saying into middle of December, right? That's when that contract expires. So it's very possible that we calm down, we get the election result, markets have a relief rally, realize kind of stabilizes, and we start pricing in Christmas basically. And maybe there's some optimism on the vaccine front. So all those things are generally quite bullish and quite bad for vol. So maybe at push, you can get that December contract down to something like 22. Maybe that's the most it can get down to. But in that case, where's January contract going to be? Well, that curve normally trades upward sloping. So you could see January at something like 24, okay? So that's probably your best case scenario in a normalization of the curve, that we go back to an upward sloping curve. But that, if you look at the upside you would have, if you sold December futures, then you can make 10 vol points. Whereas if you buy January, you'll lose 6, okay? So there's a good 4 vols to make if you do that calendar spread. If you sell December and you buy January, in a market that continues to remain stressed, it's not really clear how much more this curve is going to steepen, because it's already steepened quite a bit. And we know it's there because of the election, which is about to get taken out. The election event is about to pass. So your kind of risk reward, I don't feel like it can steepen that much more than what it is here, unless we go into a real disaster scenario, okay? But you can give yourself a stop. But the point is, you know that it's already in a stress state, and in a normalization, you know, arguably you've got 4 vols to make there, basically, yeah? So that would be kind of how I would think about another relatively defensive play, because you're not outright selling too much vol, it's a calendar spread, and it's already stressed. Whereas if things normalize, you'll make some money, okay? And then the last way you can express it, again, in a safe manner, is to just buy puts. The thing that's going to come down the most is that December contract, potentially going to go from 32 to as far as 22. And you could buy puts on that. So you could buy like the 25 put in December for around a vol and a half, something like that, knowing that that put won't, unlike most options that decay in value through the passage of time, this one will not only hold its premium, but will likely multiply its premium by 2 or something like that in a normalization. And you know you can't lose more than the premium that you spend. So again, a defensive way to sell vol, but limit how much you can lose, okay? So those are for me, those are the 3 ways that you can sell vol quite defensively, quite safely, but benefit from a normalization and the fact that this, arguably, this election could be one of the most overpriced events of the year, right? That's what it feels like to me, right? Because I don't feel any of the outcomes, except for the crazy unlikely one. There's not many outcomes that are particularly market negative, in my opinion. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.